We've officially had 2 days in correction territory for the Nasdaq. That's quite significant. We haven't had that the entire coronavirus pandemic. So we certainly have to take note of things here. Energy stocks, because we have a lot of exposure there. Starting the day kind of weak. I saw right across the board. I saw the price of oil down. And then all of a sudden, they break into the green. And they hold that green along with everything else. And along with everything else that was also in the green, they turn down. What are we doing here? What's up with these head fakes? How do we navigate going forward? Well, the most important thing is the fundamentals. Let's not forget, fundamentals are ultimately the base of our energy thesis and what have brought us those fantastic gains. And I think if we remain stuck with the fundamentals, we can calmly navigate this market and hopefully reap rewards. So there's two buckets that we've talked a lot about in this channel. However, one bucket is becoming particularly interesting right now, and that is the 10x growth tech. We've obviously seen our gains in energy. We're about to get into earnings season. We're going to probably see some good stuff there. But over here, I'm starting to see signs of life. And I know I've talked about seeing signs of life, but it's been more about price. It's been more of the massive decline yielding good buying opportunities. Now I'm actually seeing signs of life, and I want to talk about them. So one of these companies I really like is called Smile Direct Club. Smile Direct Club produces Invisalign pseudo braces for their clients, and they've got fantastic stores all around the country, and they're a direct-to-consumer business. In my opinion, they deserve a much larger valuation given the kind of market they're going for. But obviously, the total addressable market thesis is not something people want. People want cash here and now. The stock had a 20% rally day yesterday, and then it pulled back to about up 8% on the day, roughly. It was up 20% in one day last week. I believe it was Thursday. Came back. We had 7% up yesterday. Came back. We had another 7% up today. Came back. Now, 7% is quite a strong move, and this isn't some unknown penny stock. This is a very well-known stock, and it was previously a double-digit stock, now down around $2. This is a public company, obviously, but it's not a publicly known company. There are ads for it on Snapchat. There are people who actually get this product. It's not pre-revenue. They make hundreds of millions of dollars in revenue per quarter. So this is not some random business that has 10-year projections. Yes, there are 10-year projections for it, but they're actually current results for this business. It's very different than even the CRISPR stocks that I like that don't really make money and are really just future money. This company makes money now. However, it's being lumped in the tech bucket, which is obviously slowing down quite a lot. But I'm taking high levels of optimism from these 3 days I've talked about, the 20%, the 7%, the 7% days, 3 of the last 4 days seeing those kinds of moves. Frankenstein coming out of the grave type stuff, in my opinion. Yes, obviously we have this spill into the close. But what is that? Is that a real type of move? Is that something that should happen? In my opinion, no. There should not be quite large rallies. I'm talking many of these stocks that I'm looking at are up 5% and then they close the day in the red. That's not natural. That's not how stocks should move. It does happen, I suppose, in downtrends. And there's certainly an argument to be made that we are in a downtrend. However, my counter argument to that, with regards to these 10x growth stocks that have very good fundamental cases. Fundamental cases. How do we begin this video? Fundamentals. There are fundamentals for Smile Direct Club replacing braces of product and then making a whole lot more than their current less than $1 billion market cap. Fundamentals there. This has been a year-long bear market for some of these companies like Smile Direct Club. They are not just entering correction territory now. They have been in correction territory for months and months and months. And some of them are actually good businesses and were debatably good in the January, February pricing. I mean, if you were watching this channel then, or if you're a client of mine, you know we were selling stuff then. Now we're starting to like it again. If there's a fundamental case for these stocks, and if you believe in that fundamental case, I'm starting to see signs of life. And I'm not afraid to buy here. I'm not afraid to buy. However, we have to acknowledge when we buy that we're fighting the tide by buying, okay? Full disclosure, we are fighting the tide by buying these stocks. The tide is clearly down. It's been down for a year. It's been nothing but down for the most part. So if you can acknowledge that and you can find a fundamental case and you can prepare to take additional hits and not see any positive gains as you continue to fight the tide, well, then I would honestly suggest continuing or beginning to nibble on these stocks that have spent the last year down and might be down 80%, which Smile Direct Club is, which Editas is, and which I'm happy to see putting new capital to work and realizing some gains in our energy stocks. We're getting some Schlumberger earnings out tomorrow. Hopefully they will beat. They have consistently beaten, while Baker Hughes, who missed and was up 4% at one point today, closing the day over 1.5%, they missed. So if we can get a beat out of Schlumberger, hopefully we get some better results than Baker Hughes. We'll see. Anyways, I'm liking what I'm seeing. I'm liking the fundamentals. I'm even liking some of the price action. I'm an optimist at this point in time. Not an optimist for the broader market, okay? Let me backtrack on that. The FANGs, the chips, I think are super expensive, and they're going to see a lot of supply coming in the near future, and I think they have the stocks that have been just safe havens and have been places to put capital because yields have been so low. Those stocks, despite them being fantastic companies and producing fantastic products, in my opinion, are the more vulnerable ones. The ones that are causing the Nasdaq to hit correction now, that are in the now correction, that weren't in the correction before. Those companies have been alternatives to bonds, okay? Nobody's choosing between Smile Direct Club and Editas, and a 10-year U.S. Treasury. That's not the case. But people are choosing between Apple, Microsoft, AMD, Amazon, Nvidia, and a 10-year bond. Okay? That over here, those big companies that are super expensive and have growth, not going to deny that, but are already being valued relative to earnings. They, in my opinion, are the ones that are most susceptible to a pullback. I mean, they haven't seen it in years. So if anyone's going to see it, in my opinion, and I've laid out that case, everyone's talking about yields. I don't see them getting very specific. I don't see them differentiating between Editas and Smile Direct Club and the mega cap tech, which is the actual replacement for yields, not the other stuff, which will grow well more than... What have we gone? We've gone from 1.3 to 1.9, will be a generous 1.9. I see Smile Direct Club, Editas, growing well more than 0.6%. You get down to Microsoft, Apple, Amazon, not only are they overcrowded, but then they're actually way closer to that 0.6%. So that's today's video. Hope that cleared things up for you. As always, feel free to drop questions in the chat, in the comments. We love talking. So that's today's video, and until next time, peace out.